What if I told you that 90% of professional fund managers, the guys in the expensive suits on Wall Street, actually fail to beat the average return of the market over the long term? They spend 80 hours a week analyzing charts, and yet a lazy investor who spends 10 minutes a year clicking one button usually ends up wealthier. Today, I'm showing you exactly how to be that lazy investor. We're talking about index funds. By the end of this video, you won't just know what they are. You'll have a step-by-step roadmap to start building a portfolio that grows while you sleep. No stock picking, no guessing, just math. What is an index fund? The grocery cart analogy. Most people think investing is like picking the fastest horse in a race. That's individual stock picking. It's high risk, high stress. An index fund is different. Imagine you go to the grocery store. Instead of trying to guess which single apple in the bin is the juiciest, you just buy the entire basket. If one apple is bruised, it doesn't matter because you have 499 others that are perfect. An index is just a list of companies. The S&P 500, for example, is a list of the 500 largest companies in the US. Think Apple, Amazon, Disney, and Microsoft. When you buy an index fund that tracks the S&P 500, you are buying a tiny piece of all 500 companies at once. Why is this a beginner's superpower? 1. Instant diversification. You aren't betting on one CEO's ego. 2. Low effort. You don't need to read earnings reports. 3. Self-cleansing. If a company in the index fails, it gets kicked out and replaced by a rising star automatically. ETFs versus mutual funds. When you start looking for index funds, you'll see two terms: ETFs, exchange-traded funds, and index mutual funds. This is where many beginners get stuck, but it's simpler than it looks. Feature ETF, exchange-traded fund. Index mutual fund trading. Bought/sold like a stock throughout the day. Traded once a day after markets close. Minimums. Can often start with just the price of one share, $50 to $100. Sometimes requires a minimum, $1,000 to $3,000. Fees extremely low. Low, but check for load fees. The verdict. For most beginners starting with a smaller amount of money, ETFs are the way to go because of the low entry barrier. However, if you want to set up an automatic set-it-and-forget-it monthly transfer, mutual funds can be easier to automate. The 3 pillars of index investing. To succeed, you need to look at 3 specific metrics before you click buy. 1. The expense ratio. This is the fee the fund company charges you. Since index funds are run by computers, this should be dirt cheap. You're looking for something like 0.03% or 0.05%. Avoid anything above 0.50%. That's just Wall Street taking a bite of your sandwich. 2. The tracking error. This tells you how well the fund follows the index. If the S&P 500 goes up 10%, the fund should go up 10%. If it only goes up 8%, something is wrong. 3. The holdings. Always check what's inside. If you buy a total stock market index, you're getting everything. If you buy a tech index, you're only getting tech. For beginners, broad market funds are the gold standard. Step by step. How to actually buy. All right, let's get practical. How do you move your money from your bank account into an index fund? Step 1. Choose a brokerage. You need a house for your investments. The big 3 for index investors are Vanguard, Fidelity, and Charles Schwab. They are the cheapest and most reliable. Step 2. Open the right account. If this is for retirement, look at a Roth IRA, tax-free growth. If you want to be able to withdraw it whenever, open a standard brokerage account. Step 3. Search for the ticker symbol. These are the 3 or 4 letter codes. VOO, Vanguard S&P 500 ETF. VTI, Vanguard Total Stock Market ETF. SWPPX, Schwab S&P 500 Index Fund. Step 4. Set it on autopilot. The secret to wealth isn't timing the market, it's dollar-cost averaging. This means you invest $100 or $500 every single month, regardless of whether the market is up or down. When the market is down, your $100 buys more shares. It's like a permanent sale. The math of wealth, the motivation. Let's look at the numbers. The S&P 500 has returned about 10% annually on average for the last several decades. If you invest $500 a month into a low-cost index fund starting at age 25, by the time you're 65, you'd have approximately $3.1 million. You didn't have to find the next Nvidia or next Bitcoin. You just owned the entire economy. You stayed consistent. That is the power of compounding. The hidden enemies of wealth: taxes and inflation. Now, we've talked about how to grow your money, but we haven't talked about how to keep it. There are two silent thieves that want to take a bite out of your $3.1 million. Taxes and inflation. If you don't plan for these, your lazy portfolio might end up working harder for the government than it does for you. The tax dragon. When you sell a stock for more than you bought it, the IRS shows up at your door asking for their cut. This is called capital gains tax. Short-term capital gains. If you hold an index fund for less than a year and sell it, you are taxed at your regular income tax rate, which could be as high as 37%. Long-term capital gains. If you hold for more than a year, that rate drops significantly, often to 15% or even 0% depending on your income. This is why lazy investing wins. By not constantly buying and selling, you defer those taxes for decades, allowing that money to stay in your account and compound. Inflation, the invisible erosion. $100 today won't buy the same amount of groceries in 20 years. Historically, inflation averages about 2 to 3% per year. While your index fund is aiming for a 10% return, your real return, the actual purchasing power you gain, is closer to 7 to 8%. This is exactly why keeping your money in a savings account is a losing game. With interest rates often lower than inflation, your safe money is actually losing value every single day. The index fund isn't just a wealth builder, it's a shield against the devaluation of your currency. The all-weather portfolio, beyond just the S&P 500. While the S&P 500 is the gold standard, putting all your eggs in one basket, even if that basket has 500 eggs, can be a bumpy ride. What if the US economy enters a lost decade like Japan did in the 90s? To be a truly elite lazy investor, you need to consider global diversification. International index funds. The US represents about 60% of the world's stock market value. That leaves 40% of the world's opportunity in places like Europe, Japan, and emerging markets like India or Brazil. VXUS, Vanguard Total International Stock ETF. This gives you exposure to thousands of companies outside the US. The Total World Approach, VT. If you want to be the ultimate lazy investor, you can buy one fund like VT, which owns nearly every public company on the entire planet. The role of bonds. As you get older, you might want to add a shock absorber to your portfolio. That's what bonds are. While stocks are ownership in a company, bonds are a loan to a government or corporation. They don't grow as fast as stocks, but they don't crash as hard either. A classic beginner strategy is the three-fund portfolio, a total U.S. Stock Index Fund, VTI, a total International Stock Index Fund, VXUS, a total Bond Market Index Fund, BND. By adjusting the percentages of these three, you can control how much turbulence you're willing to stomach. Surviving the red days, the psychology of the crash. Here is the part most gurus won't tell you. At some point, your portfolio will drop by 20%, 30%, or even 50%. It happened in 2008, it happened in 2020, and it will happen again. The math of loss. If your $100,000 portfolio drops to $70,000, your brain will scream at you to sell now before it hits zero. This is the moment most investors fail. They sell at the bottom, lock in their losses, and wait until the market is high again to buy back in. The buffet mindset. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." When the market crashes, index funds go on sale. If you continue your $500 per month contribution during a crash, you are buying those 500 largest companies at a massive discount. Statistics show that the S&P 500 has recovered from 100% of its historical crashes. The only way to lose money in an index fund over the long term is to panic and sell. The lazy investor doesn't check the news. They check their automated deposit and go back to sleep. Rebalancing. The only work you'll ever do. I promised you this was lazy, but there is one maintenance task you should do once a year. Rebalancing. Imagine you decided on a portfolio of 80% stocks and 20% bonds. After a great year for the stock market, your stocks have grown so much that they now make up 90% of your portfolio. You are now taking on more risk than you intended. Rebalancing is the act of selling a little bit of what performed well, selling high, and buying more of what performed poorly, buying low, to get back to your 80-20 target. Frequency. Do this once a year on your birthday or New Year's Day. Method. Most brokerages like Fidelity or Vanguard have a rebalance button that calculates this for you instantly. This simple act forces you to follow the #1 rule of investing. Buy low, sell high, without needing to guess when the low or high actually is. Index funds are the foundation of wealth. They give you the growth of the stock market with the lowest possible stress. But once you start building that portfolio, you might notice something. Some of those companies in your index fund actually pay you thank you checks just for owning them. These are called dividends. If you want to learn how to turn those dividends into a stream of passive income that can eventually cover your rent or your mortgage, you need to watch my next guide. Dividend Investing for Beginners. Build passive income, step by step. Click that video right here to start building your paycheck from the stock market. I'll see you there.